One bank just crossed a line that most people didn't even know existed. It now sits on a silver position so large it can steer the entire market, and it quietly flipped from pushing silver down to needing silver up. That's the event. JP Morgan spent roughly 15 years stacking physical metal while the public was told silver is dead money. And now the pivot is visible. The short side pressure is gone, the hoard is built, and the incentive has changed. If you think silver's price is just a chart, you're already behind. This isn't about a candle, it's about control of supply. Quick intro. This channel breaks down what the big players do before the headlines catch up. Subscribe right now. Short, simple, and effective. Subscribe, because the moves that matter happen quietly. And drop a comment with one word so I know you're locked in. Wake up. Now let's get into it, because once you see the structure, you can't unsee it. Here's the uncomfortable reality. In silver, paper sets the screen price, but physical sets the survival price. If enough people demand delivery, the paper game gets exposed instantly. And that's exactly why this bank's behavior matters more than any influencer debate, more than any moonshot thread, more than any day-to-day swing. The story is not silver went up or silver went down. The story is the largest private silver position on earth has shifted incentives. For years, the public narrative was simple. Gold is safe. Silver is speculative. Keep your savings in the system and don't bother with the metal that never moves. But while that story was being sold to you, something else was happening behind the curtain. Metal was being vacuumed. Not in public, not loudly, not in one dramatic week. Quietly, patiently, relentlessly. And now the accumulation phase looks finished. Here's the part that should bother you. A bank can be caught abusing the precious metals market, pay a fine, and still walk away with the metal. The penalty hits the headline. The position stays intact. You don't have to agree with it. You just have to understand what it means. Because in markets, morality doesn't set prices. Positioning does. If you want a snapshot of how serious this is, remember the basic point. The entire paper structure only works if most participants never ask for the real thing. The moment demand shifts from trade the contract to deliver the metal, the math gets ugly. And we are seeing behavior that looks like stress. Now the timeline matters because this wasn't built overnight. Go back to the aftermath of 2008. That crisis didn't just break confidence. It forced consolidations, takeovers, and the transfer of risk from the weak to the strong. One of the most important transfers was in the silver short structure. A major Wall Street failure carried a massive bet against silver. When it collapsed, those positions didn't vanish. They got absorbed. And JP Morgan didn't just inherit that exposure and run. They used it. Think about the advantage in that move. If you can lean on price with paper, create air supply at critical moments, then you can keep physical cheaper while you build a warehouse position. That's not magic. That's a strategy. Paper to suppress, physical to accumulate. And you don't do that for a few months. You do that for years. Because in a tight commodity, time is how you win. Now the manipulation fine matters here, not because we need to argue intent, but because it shows something simpler. The market has already been judged vulnerable to games. The public sees a number, hundreds of millions, nearly a billion, and assumes problem solved. But fines don't unwind positions. Fines don't refill vaults. Fines don't create new mine supply. A fine is a cost of doing business. And if the payoff is control of a strategic metal, that cost can look small. So when people ask, how can this be real? The answer is, because the system allows it. Now let's talk about scale, because scale is what turns interesting into dangerous. We're not talking about a stash that's big compared to a local dealer. We're talking about a hoard that rivals market infrastructure. Roughly speaking, global mine supply is on the order of hundreds of millions of ounces per year. That's the flow. A position in the hundreds of millions is not a trade, it's a structural lever. It means you can be the marginal seller or the marginal holder at the exact moment the market is desperate. And in commodities, the marginal unit sets the price. That's why who holds inventory matters more than who tweets. Now, in the script you're hearing everywhere, the number thrown around is about 750 million ounces. Whether you view that as exact or approximate, the point remains, it is enormous. It is large enough to make the exchange inventories look small by comparison. It is large enough to make delivery months feel tense if demand spikes. It is large enough to make industrial buyers care, because industrial buyers don't care about narratives, they care about supply. Here's where the story turns. For years, the logic of suppressing price made sense if you're still accumulating. Cheap metal is the goal. But once the hoard is built, cheap metal stops being the goal. Now the goal becomes revaluation. Now you want the chart to catch up to the vault. And that's why the short position shift matters so much. Because it signals that the keep it down while we load up phase is ending, and the let it run phase can begin. If you want to understand incentives in one sentence, here it is. When you hold hundreds of millions of ounces, every dollar move becomes a weapon. A $1 rise isn't $1. It's $1 times your inventory. And that math scales into billions faster than most people can emotionally process. So ask yourself, did they build this to watch silver drift sideways forever? Or did they build it to be there when the reset happens? Because the bank doesn't need your approval. It needs the market to do one thing: reprice scarcity. Now we have to talk about how fragile the paper structure is, because this is where most people get lost. They think COMEX is the silver market. It's not. It's a pricing mechanism built on leverage, netting, and assumptions about delivery behavior. Most contracts never lead to physical settlement. That is not a secret. That is the design. But design becomes a trap when confidence shifts. The crude ratio that keeps showing up, paper claims versus registered inventory, captures the risk in one ugly picture. Lots of claims, not much deliverable metal. So the whole structure relies on calm. As long as traders treat the contract like a chip in a casino, the casino stays open. But when enough players demand the chips be redeemed for actual metal, the casino runs out of cash. That's when price discovery becomes price emergency. And the behavior that matters is not what people say, it's what they do. Metal leaving vaults is a loud signal. Deliveries concentrated in one dominant player is a loud signal. Premiums in physical hubs refusing to collapse even when paper dips is a loud signal. Because real markets don't care about screen quotes. Real markets care about availability. Now here's something that should snap your attention back to the present. If a huge percentage of deliveries on a key day comes from one entity, that tells you something simple. Most of the market can't deliver. They can trade, they can hedge, they can talk. But deliver? That's different. Delivery is where the story stops being theoretical. And if the system increasingly leans on one player to meet delivery demands, that player becomes a gatekeeper. That's control. Not in the dramatic movie villain way, in the quiet, we can meet the bids while others can't way. And that is often more powerful. Now layer in another force, supply control outside the West. In your script, the claim is that China tightened export controls on silver starting January 1, 2026, treating it more like a strategic input than a casual export. Again, we're not here to verify, we're here to model what the narrative implies. If China is a refining choke point, and it decides to keep more silver inside its own system, that reduces available flow to the rest of the world. Even if global mine output stays the same, the distribution changes. And distribution shocks are what trigger price shocks. Because factories don't run on global averages, they run on local deliveries. When a manufacturer can't source, it doesn't matter that somewhere silver exists. It matters that it isn't showing up where it's needed. So now imagine the squeeze described by this script. In the West, a single bank sits on an unprecedented hoard and shifts to wanting higher prices. In the East, a strategic gatekeeper tightens flow. And in the middle sits an exchange structure that depends on people not requesting delivery. That's a three-sided pressure. It's not about whether silver is popular, it's about whether the supply chain can handle a shift in behavior. Now let's talk about the physical versus paper spread, because this is where people finally feel the difference. When paper says one number, but real-world hubs trade metal at a much higher number, the market is telling you something. The price on the screen is the price of a promise. The price in the street is the price of a substance. And when those diverge, it's not a small detail. It's the system confessing stress. Normally, arbitrage should close that gap. Buy cheap here, sell expensive there, profit. That mechanism is supposed to keep markets honest. But arbitrage only works if delivery is reliable, logistics are feasible, and the supply is actually available. If any part breaks, if delivery delays, if metal can't be sourced in size, if premiums are too volatile, then the gap persists. And when the gap persists, it becomes a billboard. The paper market is no longer the whole story. Now, the next question everyone asks is the Hunt brothers question. Didn't this already happen? Didn't someone try to corner silver and get crushed? Yes, and that history is exactly why people are sleeping on the difference. The Hunts were individuals using leverage. They were vulnerable to rule changes and margin requirements. They could be forced to sell because their position depended on financing. A bank holding physical outright is a different animal. You can't margin call inventory sitting in a vault owned free and clear. You can change trading rules, you can squeeze futures, but you can't delete a warehouse. And if the hoard is large enough, it can outlast panic. That's the key distinction this script is trying to hammer. Leverage can be broken by policy. Physical can only be broken by confiscation, forced sale, or an alternative supply shock. And that's why the bank's position is such a big deal, because it sits in the category of hard to unwind. Now zoom out. Why would anyone bother? Because silver is not just a precious metal. It's an industrial nerve. It carries electrons better than anything else. And modern civilization is an electron story. Solar, EVs, grid upgrades, 5G hardware, data centers, AI infrastructure, power management, sensors, defense tech. It's not one industry. It's a stack of industries, all leaning into electrification at the same time. And silver is used not because it looks pretty, but because it performs. The script's claim is simple. Demand is expanding in multiple channels at once. And supply is constrained because most silver production is a byproduct of other mining. That's crucial, because it means silver isn't like oil, where higher prices quickly mobilize a massive direct supply response. If silver is largely a passenger on copper, zinc, lead, then silver supply growth depends on those markets too. So even if silver goes vertical, the supply response is slow. Slow supply response plus fast demand growth is the recipe for violent repricing. And violent repricing is exactly what a hoard wants. Because if you sit on a mountain of inventory, you don't need to predict the exact catalyst. You just need to be positioned when the catalyst hits. Now let's bring it back to the most personal part of this story. Because this isn't just market trivia. It's about how wealth transfers actually happen. Most people don't lose wealth in one dramatic day. They lose it slowly by holding claims that dilute, while someone else accumulates assets that can't be printed. So if you've been holding cash and telling yourself you're being responsible, ask the uncomfortable question. What has your cash become over the last 15 years? Now ask the other question. What has their cash become? Because if they converted paper into metal for a decade and a half, they didn't just save. They moved into a different tier of reality. And now the pivot suggests the harvest stage. That's why this moment matters more than the last price swing. It suggests the strategy has shifted from acquisition to revaluation. Now, is it too late? That's the question that makes people freeze, because they see a higher price than years ago and assume the move is done. But big commodity repricings are not one sprint. They are cycles. They are narratives that migrate from nobody cares to a few specialists care, to industry cares, to governments care, to the public panics. Most people only show up at stage 5, and then they wonder why it feels like the door is closing. If you're here while the story is still being argued, you are not at stage 5. You are somewhere earlier. And earlier is where positioning still matters. But let's be honest, there will be pullbacks. Volatility is the weapon of a system trying to shake out late confidence and early conviction. If you can't handle that, you get emotionally liquidated before the thesis plays out. That's why the best players think in years, not hours. Now, another narrative piece in your script is government signaling. The claim, silver was added to a critical minerals list in late 2025, implying strategic attention. If that's true, it means policymakers are waking up to the same issue. Electrification is metal constrained. And when governments wake up to a metal constraint, the market stops being free. It becomes political. Sometimes that means subsidies. Sometimes that means allocation. Sometimes that means restrictions. And in extreme cases, it means the public gets pushed to the back of the line. That's not fear-mongering. That's what strategic material means. Strategic materials are not treated like luxury goods. They're treated like inputs that must be secured. So if silver is moving into that category in the public narrative, the implication is simple. Industrial demand gets priority, retail access gets uncertain, and the market becomes less about what should it be worth and more about who gets it. Now, before we close this out, I want to keep you engaged with 2 comment questions, because your answers tell me what you're seeing. First question, do you think paper markets can keep setting the price if physical keeps getting pulled? Yes or no, and why? Second question, if you could only watch one indicator for the next 90 days, vault inventory, lease rates, or physical premiums, which one would you choose? Drop your answers below. I read them all. Now here's the clean checklist this script wants you to watch, rewritten in plain language. Watch exchange inventories. When deliverable metal drops, stress rises. Watch premiums. If physical refuses to follow paper down, it signals tightness. Watch lease rates. When it becomes expensive to borrow metal, scarcity is speaking. Watch industrial headlines. If manufacturers start locking long-term contracts, the bid is shifting. Watch the dominant holder's behavior. When the big horde shifts from delivering to withholding, or from withholding to selling, that's a signal. Because the real question isn't whether silver is a good investment. The real question is whether the world is entering an era where silver is treated like a strategic bottleneck. If it is, then the system has to reprice it until behavior changes. Either demand is destroyed, or supply expands, or substitution happens. But substitution is limited by physics. Supply is slow by geology and permitting. So the fastest lever is price. And if price is the lever, whoever holds inventory holds leverage. That's the heart of this story. Now I'm going to be direct. I'm not telling you what to buy or sell. I'm telling you what a massive player appears to have already decided. A position was built over years. Then incentives shifted. And the market structure around it is fragile. You can ignore that and hope it doesn't matter. Or you can treat it like what it is, a signal from the top of the food chain. Here's the final cliffhanger to sit with. If the largest private holder on Earth wants silver higher, and if physical supply tightens at the same time, then the next price move won't be a smooth climb. It will be a gap. It will be a scramble. It will be industrial buyers waking up and paying whatever clears the market. And when that happens, you don't get to calmly decide later. Later is when shelves go empty. Later is when premiums explode. Later is when everyone says, "How did this happen so fast?" It didn't happen fast. It happened quietly, for 15 years. And now the quiet part is ending. So here's your action step, simple and effective. Subscribe so you don't miss the next breakdown. And share this with one person who still thinks silver is just a meme metal, because when the narrative flips, it flips overnight. Drop "wake up" in the comments if you're seeing the pattern. And tell me your answer. Is this the beginning of the revaluation phase, or do you think the system can keep it contained?